Hey guys. All right. Good afternoon, everyone. It's been obviously quite a period of since our last class a couple of weeks ago. Um, where we're going to pick up today, last time we were looking at European securities markets, and that really takes us, we've started out looking at the why of securities. We've looked at the international aspect. We focused in on the capital raising aspect, on listings and IPOs. We've looked at regulatory structures, particularly in the UK, but also in the EU and the US. And we've looked at intermediaries and authorization. We're turning this week to questions of conduct. In other words, once you move from authorization to the conduct side. And let me bring up the slides. And as we look at conduct, we're really looking at a combination of different things. We're looking at regulation. In other words, what are the rules and requirements? But we're also looking at supervision. In other words, how are those rules supervised by the regulator and supervisor? And what goes with that is the idea of compliance by regulated firms. And it's very important when we think about securities regulation, in particular, the way in which it actually operates in the market context, to see these pieces integrated together. And one of the themes that we're going to focus on, and certainly one of the themes in the readings that I provided for class tonight, is in the context of the role of technology in that process. In particular, from the supervisory standpoint, what we think of as soup tech or supervisory technology, and what we think of from the use of technology on the compliance side, what we often think of as regulatory technology or reg tech. And I want to pick up a number of stories related to some of the ongoing themes that we've been looking at. But really from the standpoint of first pieces, I wanted to come back to those IOSCO objectives and principles. And we've seen that one aspect of those is promoting financial stability. And this idea to promote and allow for the effective management of risk and ensure that capital requirements are sufficient to address appropriate risk-taking and allow for the absorption of some losses during periods of instability to facilitate the rapid and accurate exchange of information across jurisdictions to minimize failures or the impact of that failure at an international level. And clearly, the context for this is we are now in a very highly volatile period from the standpoint of financial markets. And it's something that we had flagged earlier in the course, this idea that one of the roles from the standpoint of regulation and supervision is not necessarily to prevent volatility or even prevent failures, but to put in place systems that allow particularly markets to continue to function in the context of high levels of volatility. And that, of course, is exactly what we're seeing right now. And just pick up this story, which is from yesterday, highlighting the context of Asian trading. And it's useful because it highlights a number of the core mechanisms which we use from the standpoint of addressing high levels of volatility in markets. So, Asia stocks dive as oil spikes on Iran crisis. Asian stocks were hit hard on Monday as the U.S. and Israel's war on Iran drove up oil prices, and worries swirled over the economic fallout from the conflict amid signs tensions are broadening across the Middle East. South Korea and Japan led falls in the region. The Kospi, so this is the South Korean main stock index, had dropped almost 9% at one point, triggering the Korea Exchange to issue a circuit breaker on trading before ending the day down 6%. So, what is this? One of our key mechanisms in the context of market volatility is what are called circuit breakers. Circuit breakers basically say that if the overall market falls by a certain amount, often around 10%, in a short period of time, often an hour, that many markets will have what are called circuit breakers. They're effectively a timeout. Basically, the market stops. The idea is that gives people the opportunity to sort of gather their thoughts and calm down a bit. The view that sometimes when you're seeing high levels of volatility, you may actually be seeing panicked behavior by market participants. And there's the view that quite an effective mechanism for this is to give market participants literally a break, a timeout. Close the market, let people calm down, figure out what's going on, come back. Very frequently, the market will drop again. That's not unusual, but it does give an opportunity for people to think through what they're doing. It also, importantly, gives one an opportunity from the standpoint of automated systems to review whether everything is working appropriately. In other words, as we flagged, there is a risk with automated trading systems, which of course dominate market activity globally, of getting a self-fulfilling spiral downwards. In other words, that once prices drop by a certain point, you may well get automated sell orders, which will then trigger mass selling, which will drive prices down again. And so, circuit breakers are often a mechanism to try to address these sorts of mechanisms. The other aspect that you'll frequently see is that most major market regulators will go through what we call periodic periods of stress testing. In other words, we looked at this idea of regulation of market intermediaries, both from the standpoint of things like broker-dealers, but also from the standpoint of exchanges themselves. And normal practice is you will have periodic, essentially, tests to see how these sorts of trading systems will perform under highly stressed conditions. And typically what you'll do is you will take the most recent episode of stress in markets and use that as a benchmark for testing. What that means right now is that we're often using COVID from the standpoint of stress test benchmarks. And COVID was a very volatile time in markets. We had incredibly rapid drops followed by incredibly rapid rises. And that provided, if you will, a very good example of high levels of volatility. And often when we're looking at testing of exchange systems around the world today, those will be our baselines from the standpoint of testing. Now, what I have flagged is you will see trading systems go down periodically from exchanges. We haven't had a major episode of that yet, though interestingly a couple of weeks ago, the Chicago Mercantile Exchange's systems, particularly around gold, suffered some issues. But they seem to have been functioning in the context of the volatility over the past week. So, one piece is these ideas of circuit breakers, which are designed to, if you will, give a pause to markets. The second idea is periodic stress testing, particularly of your intermediaries. The third will be issues around financial safety and soundness of intermediaries, particularly funds and large broker-dealers. And this process involves aspects of capital requirements, liquidity requirements, systems testing, etc. And we'll come back to some of those a little bit later. I want to pick up one more example, which just highlights from the standpoint of market participants the reality of what high levels of market volatility can mean. And this is interesting because the last time we had similar sorts of stories really was in the context of COVID. Historically, one would have had trading floors. In In other words, a trading floor, a major financial firm, a trader, broker-dealer, hedge fund, typically you would have had all of your traders working from a centralized floor in a place like London or Hong Kong, Singapore, Dubai, etc. This would have been your norm pre-COVID. One reason for this is in the context of a trading floor, every conversation that a dealer has must be recorded. So if you're a trader, everything that you say while you're at work is recorded. Now, COVID clearly was a challenge to this. In other words, how do you deal with traders, the fact that they couldn't trade in the office? But we needed markets to keep functioning in the context of the pandemic and the lockdowns. And so one has very quickly, in the context of COVID, the imposition, the establishment of tools which essentially allow the recording of keystrokes, activities at a distance by traders, and trading activity taking place from home. So this is something that we're seeing a bit, in some cases, repeated here. So this is about oil markets, not surprisingly. Oil over the past week has been a very volatile market. Inside one of the wildest days the oil market has ever seen, how one London trading floor coped with a record swing in prices. Manny Newman powered up the 10 screens on her desk in London's South Kensington late Sunday night. So this is at home. She's at home with 10 screens, bracing for what would become the most volatile trading session the oil market has ever seen. Over the next 23 hours, the benchmark Brent crude price surged to as high as $119 a barrel before plunging to $84 a barrel, the biggest intraday swing in dollar terms on record. Newman, 32, is a market maker at Onyx Commodities, a trading firm that continuously quotes prices to buyers and sellers in oil markets. Even for an experienced trader, Monday's chaos was unlike anything she'd experienced. I've been through a lot of crises, including COVID, Russia, the Saudi oil attacks in 2019. They were all like nothing yesterday. The pace of trading she had felt like playing a video game, and this is a common theme that we're seeing from quite a lot of market participants these days. Felt like playing a video game for 24 hours straight. Now, note that essentially what the firm does is they're a market maker. They are buying and selling from whoever wants to buy and sell. Think about that Citadel business model that we've talked about. Essentially, they stand in the middle, ready to buy or sell. They are both making a market, but they are also continually referring to exchange traded prices in markets. Onyx traders were living off electrolyte drinks, creatine powder, nicotine patches, and power naps. We turned our boardroom into a motel. We've got sleeping bags in there, very common in the COVID context. Last night I fell asleep to Trump's speech, woke up at 3 a.m. to check the market, and then was up at 5:30 a.m. The stakes have rarely been higher. Onyx, which employs 60 traders in London, Dubai, and Singapore, quotes prices on thousands of contracts covering crude oil and refined products such as diesel and jet fuel, most of which are linked to the benchmark oil price. On Monday, the scale of the price movements made that extraordinarily challenging. Oil markets, which are closed over the weekend, initially surged as the conflict in the Gulf escalated after the FT reported on Sunday that Saudi Arabia and UAE had become the latest exporters to cut production. They fell back sharply on news that governments were considering a release of emergency oil stocks, and then on U.S. President Donald Trump's declaring the war, quote, very complete. We are seeing the biggest moves you can imagine, so imagine that you then have to determine a price. And this is something that, we talk about this idea of financial markets as being about establishing prices. In conditions like this, the simple process of establishing a price is not easy. And I think this highlights one of the challenges of markets. The difference between buying and selling prices, known as the spread, which is normally a few cents a barrel, widened dramatically to as much as $10 because there was just no way to know where things were. In other words, generally speaking, when there's a buy and sell price in an actively traded market like many shares or commodities like oil or gold, you'll have quite a narrow spread because you have lots of buyers and sellers who are continually transacting, and those differences between buy and sell get very close. Now, in the context of highly volatile markets, the uncertainty about price movements, you don't know in the next few seconds whether something is going to happen that's going to dramatically drive the price up or down. So you end up with buyers and sellers adding to the distance between prices to protect themselves against volatility. We are one of the biggest volume traders in oil. If you make a mistake, we talked about fat finger trading. If you make a mistake, normally it might be a 10,000 mistake. But yesterday it would be like a 2 million mistake. At times, the challenge overwhelmed traders. A couple of our guys said they just needed to stop for a bit. The moves were so big, it was hard to get a sense of it. Newman said he had also spent the weekend evacuating 15 traders and their families and pets from Dubai, chartering an Airbus jet from Marseille to pick up the team in Fujairah, stopping in Rome to refuel, and then returning to London. Now, the last line. The traders arrived in time to go to work for the market open. In other words, this wasn't charity that the firm was taking them out. It was getting them lined up so that they could work first thing in the morning. Much of Onyx business involves helping oil producers, refiners, and trading companies hedge their exposure to price swings. Companies use these trades to lock in prices for oil they will produce or consume in the future. People are trying to lock in prices over time and in different regions. Refineries might want to secure the margin between the crude they buy and the fuel products they sell. In other words, you have a production process. Production takes time. You're selling what you're producing, ideally at some sort of price. You want to have some predictability about your input costs going in. One of the areas where we're seeing some of the biggest volatility right now, jet fuel. Jet fuel takes petroleum products. We have the combination of the uncertainties around the conflict plus travel, plus the volatility in the context of oil prices. So if one is an airline, note that many airline prices have stayed not stable. We've all seen airline prices going up, but they haven't necessarily gone through the roof, which one might expect. Why? Airline companies tend to hedge against price swings for a certain period. But after a certain period, those hedges will go away, and that's when, if we're seeing prices up, that one will see the big impact. So, huge price spikes provide a great opportunity for oil producers, obviously, who can sell contracts on their future output. If the oil price goes up 20%, that is a huge economic shift for someone. Producers just made 20% more on a barrel that they might not yet have produced. But on Monday, the normal balance between buyers and sellers at times broke down. As prices surged, buyers rushed in to secure supplies at higher prices, yet few traders were willing to take the other side because of the uncertainty. The market lurched the other way as speculative traders unwound positions. And this is a key point. Newman said financial speculators play a far larger role in oil trading than they once did. Today, we do not know who is behind some of the financial trades and what information they might have. They might come in very aggressively, and you ask, do they know something you don't. He added, before you know it, the market's lost control of the narrative, and everyone has to exit because they cannot handle price swings. So, what this highlights is essentially something that we know in the context of financial markets. Volatility is to be expected. Crises, unstable systems. As a result, one of our core focuses from a regulatory standpoint is one, trying to figure out how to calm things down when possible, and that's your circuit breakers idea. The second is from the standpoint of trying to make sure that the infrastructure, particularly the exchanges and clearinghouses, continue to function regardless of what is actually happening to prices. That's quite important. The third is really around making sure that the market intermediaries have been stress tested against volatility. And the fourth, which we've highlighted a lot throughout the course, is information. The better information that is available in markets, the better decisions participants will be able to take, and the better things tend to function. So far, nothing significant has failed on the financial market standpoint. But the longer periods of highly unexpected levels of volatility continue, the more likely it is that something will happen. And so, in addition to the financial institutions monitoring themselves, you are having at the moment a lot of activity from financial regulators, both monitoring the exchanges and trading systems, but also continually talking back and forth to firms and market participants about their positions. All right, so that's really kind of picking up on this part around financial stability. What I really wanted to turn to today is looking at this idea around conduct. And as we look at conduct, if we turn back to our sets of principles, we can actually see that pretty much throughout, this aspect of conduct is central. And the conduct part tends to go both to market fairness and efficiency. In other words, you want to make sure that markets are fair and efficient, and as a result, you have rules of conduct for participants. You also have rules of conduct from the standpoint of investor protection, protecting investors from misbehavior in particular in the markets. And often one tends to spend a lot of time on things like insider dealing. But the reality of where the biggest single problem from the standpoint of market conduct is less insider dealing and more flat-out fraud. In other words, fraud, someone who is actively trying to rip off investors. This is often our core focus. And how you deal with that is a combination of information. You need information in the markets so that investors, participants have some idea of who they're dealing with. You have licensing. We saw a couple of weeks ago as we were talking about intermediaries, you have this idea of that if someone is a licensed intermediary, at least there has been some process of vetting and review of those firms. And you have enforcement processes, mechanisms which are designed First, to try to capture misconduct when it happens, but those enforcement processes also drive compliance processes by financial institutions. In other words, one of your biggest tools in policing markets are the financial industry participants themselves. And that is really this idea of compliance. And if we look through the IOSCO objectives and principles, certainly if we look at principles relating to the regulator, we've just flagged this aspect of Principle 6. The regulators should have or contribute to a process to identify, monitor, mitigate, and manage systemic risk appropriate to its mandate. And this is something that prior to really the 2008 financial crisis, generally speaking, we didn't include this systemic risk mandate. That is a post-2008 change, a recognition that securities markets can be sources of systemic risk. 7, regulators should have or contribute to a process to review the perimeter of regulation regularly. We flagged this a number of times, but this is really the idea about, particularly as we think about conduct, who is caught within the net. In other words, there are clearly things where there's fraud and misconduct, but not everything is the responsibility of the securities regulator. And one of the biggest issues over the past 15 years has been in the context of things like crypto and digital assets. In other words, clearly one has many issues around market conduct and fairness in crypto and digital assets. But one of your big questions is this the responsibility of the securities regulator? That's a perimeter question. We'll return to that. 8, the regulator should seek to ensure that conflicts of interest and misalignment of incentives are avoided, eliminated, disclosed, or otherwise managed. This is one of those things where when we think about a very significant aspect of rules around financial conduct, but also consumer protection, they're very frequently around conflicts of interest. In other words, a conflict of interest, you may have a broker-dealer who is giving you advice on structuring your portfolio. But as part of that, they may be recommending certain products to you to purchase. And they may not be telling you that they will earn a commission on the products they're selling you. That is a potential conflict of interest. The interest of the financial advisor may well be different than yours. And so we spend a lot of effort from the standpoint of licensing, as well as disclosure and ongoing supervision. There are often arguments that when we think of things like insider dealing is often seen actually as a conflict of interest. In other words, if I'm the director of a listed company, it may be the case that I know what is happening inside of the company. And therefore, if I trade on that information, that may not necessarily be fair to other people in the market. So, this is one way to think about conflicts of interest. We also see situations whereby regulators, a very common situation in finance is what we think of as a revolving door process between regulators and industry. So, just appointed as head of prudential supervision at the Prudential Regulatory Authority at the Bank of England, she was immediately prior essentially head of government and regulatory affairs at Barclays Bank. Before joining Barclays, she was a senior official in the UK government, in the Treasury, where she had responsibilities in this context. Now, it may be a conflict of interest. It may be the fact that actually you're seeing benefits from the standpoint of expertise. She is going from the government to the private sector, then going back to a regulator, and that is clearly valuable expertise that she has gained in the market that she's taking with her. But also from the standpoint of the private sector like Barclays, the fact that she's taken with her her sorts of public objectives from her government role into the role of Barclays, there's an argument that actually the markets have benefited from the private sector gaining from her regulatory and policy knowledge. So there are easily arguments both ways from the standpoint of this idea of movement back and forth between private and public sector. And we see lots of this in finance. Many of you will do this across your careers. Certainly if I think of many of my friends who started out at this point a very long time ago, that's exactly what many of them have done. There have been back and forth between different roles over time. But it is something that one needs to have an awareness of these sorts of potential conflicts of interest, mechanisms to disclose and manage those if they can't necessarily be eliminated. Self-regulation, we already highlighted this idea that SROs should be subject to the oversight of the regulator. This is an interesting one, because the IOSCO objectives and principles have gotten to the point where you can't have a purely self-regulatory function in financial markets anymore. In other words, the view is that any self-regulatory function, that there is a need for an external monitoring of that function, even if it is done on a self-regulatory basis. Enforcement of securities regulation. Obviously, all of these. Regulators should have comprehensive inspection, investigation, and surveillance powers. We saw that this is really very much the Financial Services and Markets Act, the Part 1. Regulators should have comprehensive enforcement powers. And this is really something that is key, and it usually means in most regulators a combination of civil penalties and at least the ability to refer certain things to prosecutors for criminal actions. In other words, just because it's fraud in securities, it's still fraud. And fraud is criminal in every jurisdiction. And so to the extent that you have a securities regulator in many jurisdictions, like the United States, the securities regulator will be able to undertake a criminal enforcement directly. But in many other jurisdictions, you will have a separation between the regulator and administrative powers, civil powers, and a criminal action. And that will typically mean that if you have a securities regulator in that case, if they find criminal fraud, it will get referred to the Department of Justice, the police, the criminal regulators. This is interesting. The regulatory system should ensure an effective and credible use of inspection, investigation, surveillance, and enforcement powers, and implementation of an effective compliance program. So what we have here is the embedded idea that compliance by the financial services industry is actually one of our regulatory objectives. In other words, you are trying to put in place a system that will force, or at least incentivize, the financial services industry to monitor itself. And just as an aside, if we look over the past is actually 30, 35 years. Single fastest growing area of employment in financial services has been legal and compliance. So, take an example. In 2008, Citibank had about 235,000 employees. Sizable. At that time, it had about 25,000 in its legal and compliance team. 2020, and you'll see why shortly 2020 is significant, by 2020, Citi had cut its headcount to 135,000 globally, but it had increased legal and compliance to 35,000 globally. So in other words, in an environment where they cut almost half, over a third of staff, they actually increased legal and compliance by a third. Yeah?
It's not a crazy run. It's not a crazy compliance stage. They expect it in the coming years to save costs for that. So now it's the turning point.
And this, as we come to this idea of use of technology, is one of those key aspects. In other words, compliance costs have risen to such an extent that, one, firms are, instead of just hiring more people, they're actually trying to use technology to replace people. And so we're seeing a lot of effort, and we're going to spend more time both today as well as over the rest of the course looking at this idea of the way that you use technology from the standpoint of both regulation as well as compliance. So this is a big trend. It's also, as we flagged last time in the context of the EU Capital Markets Development Project, we're seeing a lot of effort by governments to try to reduce compliance burdens in order to support growth. In other words, this idea of, have we gone too far from the standpoint of the regulatory pendulum that started with the 2008 crisis? Have we gone too far? How to push it back? And that's going to be something that's going to be interesting to watch with market volatility over the coming weeks, whether something breaks. If something breaks, that may well push the pendulum back a little bit the other way. If nothing breaks, then probably the pendulum will keep going on the deregulatory side for a while. But yeah, this is one that we're going to come back to. So, when we're thinking about regulation, supervision, enforcement, we're also thinking about compliance. Cooperation, and this I'm going to spend some time on because we've hit this idea of global markets, this idea that markets have become globally interconnected, and what that actually means is that misconduct will very frequently occur in one place that is different from where the people are involved. So, I'm going to just pick up one story from my list of news stories here, and that is this. There we go. Hong Kong launches first UK asset preservation action in insider trading probe. Hong Kong securities regulator has obtained court orders to freeze the assets of a former Hong Kong Stock Exchange executive and two of his relatives in Hong Kong and the UK over alleged insider trading. Securities Futures Commission said Tuesday that it secured interim injunctions against Chen Qinghua, former assistant vice president in the listing division of Hong Kong Exchanges and Clearings Limited, as well as his relatives, Lam Chou Man and Chao Chin Guang. The orders cover assets totaling about $550,000. The action marks the first time the watchdog has initiated legal proceedings in England and Wales to preserve assets, underscoring a more aggressive push to pursue suspects who move funds overseas. The regulator began parallel proceedings in Britain after the three left Hong Kong and transferred assets abroad, seeking to ensure funds would be available to satisfy any potential restitution order. It's a nice conflict of interest example. The SFC alleges that Chan used his position in the listing department, so listing department at the exchange, responsible for vetting company listings. So the idea is where he was responsible for regulatory compliance and rule enforcement to access confidential price-sensitive information involving at least 7 listed companies before it became public. So in other words, if you are at the enforcement division of the exchange or the regulator, clearly you are in possession of information that may be not widely available in the market. Now, typically, one will think a little bit because, particularly if you're an employee of a regulator, you will often have to disclose assets as part of your job, and the exchange is no difference in this position. So, typically, you would then think, well, if I can't make the trade myself, what I'm actually going to do is I will get someone else to trade, and then we will split the proceeds. This is pretty normal, what one would expect in an insider trading sort of context. Instead of trading in his own name, Chan allegedly used a securities account held by his in-law Lam and directed Lam to execute trades. Lam then allegedly passed the information to another relative, Chow, who traded on the tips. Chan's wife is Chow's sister, and Lam is married to another of Chow's sisters. You'd probably have to diagram that one out. The trades involve shares of several companies, and under the orders, courts have frozen assets of a variety of amounts. And so this is something that one would often see. This is a case where assets have been moved overseas. It would also be very common to have this sort of thing. You would actually get a friend or a cousin or a brother, sister, spouse, etc. in another jurisdiction to trade on the information that you pass them, on the view that that information would be difficult to access in the home jurisdiction. And this is actually something that, not surprisingly, principles for cooperation, regulators should have authority to share both public and non-public information with domestic and foreign counterparts. The idea here is that regulators should be able to share information with one another. 14, regulators should establish information sharing mechanisms that set out when and how they will share both public and non-public information, and the regulatory system should allow for assistance to be provided to foreign regulators who need to make inquiries in the discharge of their functions and exercise of powers. In other words, the idea is that actually you want to have mechanisms where if you're the FCA or if you are the SFC in Hong Kong, that if the SFC calls the FCA, that the FCA has the legal authority to cooperate with the SFC. And also that going beyond that, in addition to actually the mechanisms for how they can share information, it may actually be possible for the FCA, under certain circumstances, to assist the SFC in investigations and other sorts of actions relating to cross-border activities. And this is something where we can see two aspects. So this is from IOSCO, what is called ISCAN, the International Securities and Commodities Alert Network. So this is just an alert system. IOSCO receives alerts and warnings from its members about firms which are not authorized to provide investment services in the jurisdiction which issued the alert or warning. Some of the alerts are about unauthorized firms using names similar to those of authorized firms, or about unauthorized firms falsely claiming to be associated with authorized firms. The alerts and warnings, including in the below list, are provided by IOSCO members on a voluntary basis. Contents and warnings are responsibility of the IOSCO member, which issues them. This, the public list, is not a full list. They also have private ones where they tell one another about concerns, but without publication. So this one, regulator, this is from today. Verify icon choice. This firm may be providing or promoting financial services or products without our permission. So without authorization, you should avoid dealing with this firm and beware of scams. Almost all firms and individuals must be authorized or registered by us to carry out or promote financial services in the UK. This firm is not authorized by us and may be targeting people in the UK. This isn't a very sophisticated system, but if you think about it, the fact that a group of 130 plus regulators have actually managed to build a system where they can actually share and publicize this sort of information is interesting. What is a more sophisticated system is this. What is called the Multilateral Memorandum of Understanding. Short is much easier to pronounce, which is MMOU. What is the MMOU? It's a multilateral memorandum of understanding. A memorandum of understanding is typically a letter, a note between two regulators. You may have, and you do have, between the FCA, the Bank of England, the PRA, and the Treasury. They have a MOU about how they will work together. The FCA has an MOU with the SFC in Hong Kong. It has an MOU with ESMA. It has an MOU with the SEC in the United States. These MOUs are not contracts. They're not treaties. They're not legally binding. They're generally simply a letter between the heads of the respective agencies that outlines who to contact in the event of issues. In other words, the SFC wants to contact the FCA to ask for help in a situation. Who do you contact? You look through the FCA website and you use their contact number. It's not ideal. So typically the MOU will provide a contact channel. It will then provide, in the context of the mechanism, what we think of as an information gateway. How and what sorts of information the two regulators can share with one another, and what sorts of support they can provide to one another. This is something that took off at the international level, really in the context of mass efforts in the 1980s by the SEC to police insider trading. Wall Street movie comes from this time period, and very much you have in this period of the 1980s lots of actions by the SEC in the United States against a wide range of different parties for market manipulation, insider trading, fraud, and very frequently what they would find is that participants were in other jurisdictions, so the SEC begins a process of engaging with other regulators to come up with agreements, but not legally binding, not contracts, not treaties, just a letter that sets out who to contact, what each can do under their respective powers. IOSCO, in its international coordination role, comes up with, in 1986, a standard form MOU. That standard form MOU is then used for literally thousands of bilateral MOUs between securities regulators across the world from the late 80s across the 1990s as securities markets develop and as market globalization accelerates. Now, one of the headaches, therefore, is imagine that you are the FCA or the SFC in 1998, the aftermath of the Asian financial crisis. You have signed dozens of MOUs with other securities regulators around the world. Each of those MOUs may have used the IOSCO standard form, but it was individually negotiated. So they're each different. So each time you want to do something, you actually have to look up the MOU to figure out exactly what you can do with a specific regulator. IOSCO took this idea. One can think of it as a little bit of a parallel to a term that one used to hear in the trade context, a spaghetti bowl of agreements, and brought them together into a single MOU. The idea was that IOSCO would develop a single MOU, a multilateral memorandum of understanding, and then its membership, if the FCA and the SFC both signed the MOU, they would know that the terms of that MOU were the same, but if the SEC had signed, if the MAS had signed, if other regulators around the world had signed, each regulator would know that the MMOU provided standardized terms in the context of sharing of information, mechanisms for sharing information, and mechanisms for cooperation and enforcement. And that's exactly what we see coming from an agreement of IOSCO in 2002. This is the IOSCO website. MMOU sets an international benchmark for cross-border cooperation. Established in 2002, it has provided securities regulators with the tools for combating cross-border fraud and misconduct that can weaken global markets and undermine investor confidence. What is it? MMOU represents a common understanding amongst signatories about how they should consult, cooperate, and exchange information for the purpose of regulatory enforcement regarding securities markets. Sets out what information that can be exchanged and how it is to be exchanged, legal capacity to compel information, types of information that can be compelled, legal capacity for sharing information, and the permissible use of information. What activities? Insider dealing, market manipulation, misrepresentation of material information and other fraudulent or manipulative practices relating to securities and derivatives, solicitation and handling of investor funds and customer orders, registration, issuance, offer, or sale of securities and derivatives, activities of market intermediaries, operation of markets, exchanges, and settlement entities. Now, this, if you will, is a classic soft law instrument. It's an MOU. So it's not a treaty, it's not a contract, it's technically not binding. So what they did is something that is quite interesting. Basically, in order to sign the IOSCO MMOU, you have to apply to IOSCO for permission to be allowed to sign. Now, what does IOSCO review? They review your power and authorities of the individual regulator to make sure that you have the legal authority and power to comply with the MMOU. In other words, you can't sign if you don't have the legal authority to do everything that you're committing to do in the MMOU. And so they'll review your constituent documents, your laws, regulations, and say, we think you don't have this. You need to make certain legal changes in order to have the power to comply with this. Come back once you have done this. And in some ways, the amazing thing is the numbers. Who has signed? All government regulatory bodies are eligible. As of December 2022, 155 ordinary and associate members, of which 129 out of the 155 had actually signed the MMOU. So, they actually go one step further. One step further basically says that in 2013, IOSCO took a resolution which basically said that all members agree to sign up for the MMOU. And so we've had a process whereby the members have been reviewing each other every year to see who hasn't complied with it. Now, I think the most interesting piece from this page is this chart. Below is a table of information requests that have been made under the MMOU since 2003. So if we look at this, most recent year, 2024, between 6,000 and 7,000 information exchanges in the year. So, securities regulators had to go through a fair amount of effort to give themselves the legal authority to actually commit to this. And they are actually very active in most cases in helping sharing information across. Now, it is, of course, absolutely the case that geopolitics, like everything else, is impacting this. And certainly we do have increasing instances of regulators who, despite the existence of the MMOU, are not sharing information with one another. Russia and the US SEC are both signatories. Clearly, Russia and the US at the moment are not sharing information about securities activities. We have a number of other jurisdictions where this holds. But regardless of that, we do actually have very active use by the vast majority of jurisdictions because it's useful. In a globalized market, the chances of someone trying to commit fraud on a cross-border basis are almost higher than someone doing it domestically. It's easier in many cases. And so it's something that has been legally interesting, the way that they sort of developed this, and the fact that we are seeing very high levels of use. So let's take a break about 10 minutes here, and then we'll pick up again after, from the standpoint of really taking the move from the principles to actually looking at the UK regulatory system. Good. Code. That's good.
The assessment for this module is an essay, so I was wondering when will the topics be released?
We'll probably do it in about 2 weeks.
Oh, okay, perfect.
Yeah. All right, let's go ahead and get started. Questions, comments on anything? All right, let's pick up a couple of example news stories that illustrate some of the topics we've picked up so far. I think from the standpoint of capital raising, this is really an interesting one. The story SpaceX, the final frontier of IPOs. Can Elon Musk's moonshot deliver the mooted 1.7 trillion US dollar valuation? So this is interesting because essentially what this is the plan of Elon Musk to have an IPO for SpaceX, which is now actually the combination of the SpaceX firm plus the AI operations into a single entity. There's no real question that if this happens, it is highly likely to be the largest IPO ever. But what it does is it also illustrates a wider question about the relationship between money raised and total valuation. So in this case, the question is both how much could be, and we'll eventually probably see how much will be raised, but also what sort of value will the company trade at after it's been listed. Star Trek's warp drive allows a starship to bend space-time and exceed the speed of light without breaking Einstein's general theory of relativity. As SpaceX prepares to go public at a reported 1.7 trillion valuation, Elon Musk is attempting a comparable feat, defying the laws of financial gravity in pursuit of something the equity capital markets have never witnessed. For early investors, bankers, employees, and advisors, the fees, obviously, returns, prestige, and bragging rights would be stratospheric. At the mooted valuation, even a tiny 3% float would comfortably eclipse the US IPO record set by Alibaba's 25 billion float in 2014. A rumored 50 billion raise sounds formidable until you consider how much larger public markets have become since Alibaba went public in 2014. Back then, Apple, the world's most valuable publicly traded company, was worth around 600 billion. By the end of 2025, 10 companies had surpassed $1 trillion, with Nvidia today around 4.5 trillion. Musk is arguably the most impactful entrepreneur of his generation and has built a remarkable company. The question isn't whether there will be demand for SpaceX stock, but rather what IPO investors should pay. Based on what is reported, the price being contemplated is truly out of this world. So, this question around pricing is one of the most, if you will, arcane aspects of IPOs and finance generally. If we actually look at the process of an IPO, actually most of the process is run by lawyers. You've got to build the documents, you've got to build the disclosure systems, you've got to deal with all the filings. Most of the work and the time is done by the lawyers. What's the big thing the bankers have to do? The big thing the bankers have to do is try to figure out how much to sell it for. And that sounds easy, but it's not. And this story highlights the challenge of figuring out how much something is worth. And your risk, of course, is that if you get it right, that's great. But, if you get it wrong, that is going to impact your reputation. In other words, if they underprice it, there'll be huge demand for the stocks, and its price will go up dramatically on the first day. But then all of the shareholders prior to the listing will say, hey, we lost all that money. We didn't get it. If you had priced it right, we would have made a lot more money. Similarly, if it goes down, the risk is that the new buyers say, hey, look, you pitched this thing, you said it was going to be great, we came in and we bought it, and now it's tanked. Why would we ever trust you again? So this process of trying to get the price right, even though it's not the biggest portion of the transaction, the biggest portion of the transaction is all of these legal and documentary requirements. Getting that price right is really difficult. And this one is harder than most because generally how you're going to be doing pricing is you're going to be looking at similar companies. And for this thing, there's not really something similar. And so that makes it difficult from the valuation standpoint. The fundamental challenge for any investor is reconciling the company's financial performance with the sticker price at IPO. Last year, SpaceX generated an impressive $8 billion EBITDA, over $16 billion in revenue. However, the mothership has recently docked with much-controlled xAI, with the latter valued at $250 billion despite revenues of only $210 million and a cash burn of $9.5 billion for the 9 months of 2025. As Main FT noted last month, in conjunction with that acquisition, Musk marked up the private valuation of SpaceX to $1 trillion, citing increases in revenue from its Starlink broadband service, $200 billion more than the company was valued at in December for a secondary stock sale. So this is something that we talk about, that regulatory perimeter. When we're looking at company financing today, generally you're not talking about something where, maybe in 1999 you'd make up a company like Pets.com and you would take it immediately to an IPO and raise a lot of money. Today, generally speaking, there's a long phase before that IPO. That phase is a series of different forms of fundraising rounds, often building up series. You may start with some angel investors, you move into venture capital investors, and then a series of A, B, C, D, and the alphabet keeps getting larger for each of these capital raises. And each of those capital raises, the investors are putting in real money to buy the shares. And so one of your valuation questions says, all right, in our most recent round of private fundraising, investors put in this much money, and that would give you a sort of speculative valuation of the company at this. It's not a real valuation, but the amount of money the investors put in that fundraising round, that is real. And we've seen recently huge investment rounds. So if we look at this, OpenAI has just recently closed fundraising rounds of several $100 billion. Gigantic fundraising rounds. So in the context of valuations, the most recent fundraising round would suggest a very high valuation, and then the argument is that when you go public, the valuation may go even higher, but very difficult to price. So the point of this is to say that IPOs are by no means dead, but the process has changed, and to highlight that, yeah, the bankers do something that is worthwhile, and that's the pricing, and they're the ones that get the credit if the pricing is right, and they take the heat if the pricing is wrong. But most of the deal is run by the different legal teams putting together all of the documentation. That takes us to a second piece. Last week we were looking at EU capital markets. We've looked actually since the very beginning, we've actually seen that while EU market capitalization lags US or China or India, EU market capitalization is by no means insignificant. And this story is, I think, very interesting. And essentially this is an argument looking at data, why certain companies should raise money and do raise money in the European context. And this is actually an argument that is relevant to other countries. In other words, the factors that are leading certain types of companies to raise money successfully in the EU, these factors should also apply in the context of other countries which are trying to develop their capital markets, and basically suggest why companies from their country shouldn't necessarily go straight to the US from the standpoint of capital raising. There's a strong case for European companies to be listed in Europe where analysts and investors are closest to the story. For the past 2 decades or more, the logic of ambitious technology companies considering an initial public offering appeared quite straightforward. If scale, liquidity, and visibility were the goal, then the US seemed to be the most suitable destination, and this is a theme we've talked about. It boasts deep capital pools, experienced analyst coverage, and commands global investor attention. But as global investors now question their US exposure more, the assumption that the country should be the default listings destination deserves a much closer look. Take liquidity for starters. Recent CBOE data shows average daily notional value traded in US equities reached roughly $1 trillion last year, reflecting record activity. By comparison, full year European equity trading averages around 70 billion across exchanges, according to Rosenblatt Securities, highlighting a persistent scale gap between the regions. This is a vast difference. $1 trillion a day in turnover versus 70 billion euros for a year. That's a gigantic gap. It's so gigantic as to be, if one is looking at liquidity, there really only is one choice in this. But this is the interesting analysis. But analysis by a sixth group of European exchange data indicates that while US markets generate higher trading volumes overall, post-IPO outcomes show this is concentrated among domestic issuers. In the most recent year of fully comparable data, the average daily value of stocks traded in the US reached about 288 billion in 2023 compared with roughly 65 billion in Europe in what was a relatively weak year. Yet in the US, just 79 mega caps, about 3% of listed companies, accounted for more than half of total turnover. This is this idea that we've seen increasing concentration from the standpoint of valuation in U.S. markets, but it's also from the standpoint of trading in U.S. markets. So you have very high levels of concentration amongst trading. Now, once you get out of those largest companies, trading data from the standpoint of mid-size issuers in the US versus Europe is not so different. And this suggests that from the standpoint of smaller companies, a more localized offering can make sense. But it highlights that from the standpoint of very large companies, the US has an advantage against most others. And two more stories just to wrap up earlier themes. We talked a couple of weeks ago about the London Stock Exchange business model, its heavy data structure. We looked at a similar business model from the standpoint of NASDAQ or the New York Stock Exchanges. I highlighted that HKX has a different, more traditional business model, and this story really highlights it. HKX profit jumps 36% as trading surge fuels second record year. Operator of the Hong Kong Stock Exchange posted net profit of 2.3 billion, up 36.1% before. The performance underscores a rebound in global investor appetite for China and Asia-linked assets, giving the exchange a stronger footing as it pivots towards building out its fixed income and currencies business. Trading activity gathered pace throughout 2025. Average daily turnover in the cash market reached around 30 billion US, up 90% from 2024. Cross-border flows also strengthened. And so what you can see is compared to, say, an NYSE or a NASDAQ or the LSE, revenue for the Hong Kong Stock Exchange doesn't come from data. It mainly comes from trading activities, the fees that people pay for buying and selling. Note, trading, and if you're an exchange operator like HKX, you don't care whether the market goes up or down. Down is fine, so long as people are buying and selling lots. The best is it goes up and down all the time and people trade lots. That is the most beneficial from the standpoint of HKX's business. And that's something that, from the standpoint of our starting point around thinking of managing against volatility, the key is that you don't want your exchanges necessarily to have their success tied to whether markets go up or down. You want them to have mechanisms that allow trading throughout whatever the circumstances of those markets may be. And we have to come back just a little bit to Elliott and the London Stock Exchange. What have we seen? Elliott assures UK over future of LSE. Activist investor has privately told the government that it is not pushing for a spin-off of the exchange. So, as we sort of guessed, politically, selling off the pieces wouldn't be acceptable, and we've had some private assurances as reported here. And the other piece, what has the exchange actually done? London Stock Exchange Group plans $3 billion buyback amid Elliott pressure. So the London Stock Exchange Group plans to launch a £3 billion share buyback as it comes under pressure from activist investor Elliott Management. And so what we're seeing is an initial response from the LSE Group to use its own money to buy its shares, which should raise the price. That's essentially the idea of a share buyback. But ongoing discussions about how to further strengthen its business and revenue model. One more. Actually, I'm going to do two more. This one, because it highlights a direction. NYSE owner invests in crypto exchange OKX at 25 billion valuation. This highlights something that we're seeing, which is the exchange groups are diversifying in every case beyond pure equity. Even if we look at HKX, the statement was that it is focusing on developing its debt offerings and also its foreign exchange transactions. And several years ago, it bought the London Metals Exchange as a mechanism to increase its commodities offerings. We're seeing firms like NASDAQ, NYSE, LSE, looking at different ways that they can provide platforms for trading more forms of assets. And certainly if one is thinking about NYSE, NASDAQ, or LSE, trading more stuff also gives you more data flows. And those data flows are very valuable from everybody's standpoint. Crypto exchange OKX has been valued at $25 billion following an investment by the owner of the New York Stock Exchange as mainstream trading venues race to gain a foothold in the digital assets industry. Intercontinental Exchange, which owns the NYSE, said on Thursday it had acquired a stake in OKX in a deal that will see it launch U.S. regulated futures contracts tied to the exchange's crypto prices. The size of ICE's stake was not disclosed. Wall Street's push into digital assets comes as traditional businesses seek to compete with crypto companies for trading in new markets and blockchain-based tokenized assets. Under the deal, OKX will give its customers access to ICE's U.S. futures and tokenized equity markets. ICE will take a board seat in the Seychelles-based company, which last year pleaded guilty to operating without a license in the U.S. and agreed to pay penalties of more than $500 million. So, this is an illustration that we're seeing that regulatory perimeter tested by authorized institutions offering new forms of assets. Last story before we move on to Financial Services and Markets Act. This. So, we highlighted last time in the context of looking at the European Capital Markets Development Project, the interlinkage between capital markets and competitiveness. And the fact that largely as a result of U.S. sort of outperformance in the context of liquidity in capital markets, particularly on the equity side, we're seeing pressures in a variety of other places, including the EU, but also the UK, to improve performance. And this story relates directly to that. UK's FCA plans to publish all trading data for London-listed shares. Regulator seeks to tackle drastic underreporting of market liquidity. Britain's financial regulator is aiming to tackle a drastic underreporting of market liquidity that has driven some countries to move their listings to the US by starting to publish all trading data for London-listed firms. The FCA's unusual plan to collect and publish all share trading data from different venues, including exchanges and dark pools, highlights its frustration at which it believes is a misleading and overly negative picture of UK market liquidity. The truth is we have way more liquidity here than is often reported, and that is just silly. We are talking to loads of parties at the moment about whether the FCA can, at a little bit of risk to ourselves, step in and just sort this out. Such a move would act as a stopgap before the regulator's plan for a single stream of trading data is due to come into effect next year. Regulator believes the UK's market share liquidity data is underreported because it is only based on the LSE's central limit order book. So, a characteristic of many markets, particularly more developed markets, is that we have changed rules to allow alternative trading venues rather than giving a monopoly to the exchange on all trading of listed securities. Probably worth mentioning that in Hong Kong, HKX has a monopoly under legislation on trading of Hong Kong listed securities. So one reason that HKX is able to generate so much money from trading of securities is it actually has a monopoly on trading. If we look at, for instance, the LSE or Euronext or NASDAQ or the NYSE, in each of these jurisdictions, US, EU, UK, there is not a monopoly to the main exchange on trading of listed securities. And as a result, we actually see very large levels of trading done off exchange. Now we've highlighted, for instance, the Citadel example. And the Citadel example is exactly that they essentially, in many cases, try to match buyers and sellers directly through automated trading systems. And those trades are not necessarily put through a relevant exchange. The data may or may not be reported, and the argument here in the UK context is that people say there isn't much liquidity in the UK. They're saying that because liquidity is purely based on the LSE's trading book, but the reality is that most trades take place off of the LSE. And so the regulator is trying to find ways to essentially mandate the reporting of that information. If nothing else, as we saw in the context of the EU Big Bang article that I gave you for this week, but also our discussions of MiFID, etc., a couple of weeks ago in the European capital markets context, it may well be the case that the regulator can mandate all of this data to itself. And it may well be able to consolidate the data, this is the idea of a consolidated tape, which is then made available to markets, which gives both a more accurate picture of pricing, but also liquidity. And so the idea is that perhaps the regulator, instead of simply saying everyone must report trades, which lots of people will object to, the regulator instead can say you have to report trades to us, and then we're going to consolidate the data and make it available to market participants. They haven't commented on what this might do to the LSE's business stream from consolidating this data and selling it to people, but that's a different sort of issue. All right. Questions, comments on anything we've looked at? Let's then turn to FSMA. 3 weeks ago, when we were looking at intermediaries, authorization, and licensing, we took essentially the approach of looking at the IOSCO objectives and principles and then taking it down to the context of the authorization requirements and the regulated activities in the UK. And from the standpoint of conduct, as we've just seen from the IOSCO objectives and principles, those regulated activities, but also that authorization also brings with it a range of conduct requirements, and those conduct requirements come with a range of mechanisms to enforce them. So, if we look at, really, in many ways, our key piece here is performance of regulated activities, part 5. Included the regulated activities from last time, the authorization requirements, performance of regulated activities. So, this section isn't necessarily written in a coherent way, but it gives the various pieces of the conduct rules from the standpoint of authorized persons, your intermediaries, your licensed holders, and the FCA's powers. Now, this first one, prohibition orders. The FCA may make a prohibition order if it appears to it that an individual is not a fit and proper person to perform functions in relation to a regulated activity carried on by an authorized person, a person who is an exempt person in relation to that activity, or a person to whom the general prohibition does not apply. What does this say? Basically, it says that we looked at authorization. One of the core aspects of the authorization process is what is called the fit and proper test. Are you fit and proper? Do you have the qualifications, background, knowledge, certifications, etc., that would make you fit to hold that license? Proper comes from this old sort of British conduct idea in the 19th century of proper behavior. Are you fit and proper to get the license? And this term, which is a highly technical term, which has been input into most sort of regulatory frameworks around the world, is something that is both an initial requirement as part of the authorization and licensing process, but it's also ongoing. In other words, the FCA can determine at any point in time that someone is not fit and proper in relation to a regulated activity. And if they take that determination, they have a variety of powers, a variety of actions that they can take in that case. And in this case, you can see that it applies whether or not the person is actually at an authorized institution or not. In other words, we can think of one aspect, we saw this last time, authorization. If you don't have authorization for a regulated activity, that is an offense in and of itself. But it's also the case that if you perform a regulated activity and you're not fit and proper to do so, that's another one. And that could be either that you're at a firm, or maybe you haven't actually gotten the authorization that you needed. So it's a sort of stacked enforcement. Approval for particular arrangements. Now this is important. An authorized person, so our authorized person, this is essentially a licensed firm for one of those regulated activities. An authorized person must take reasonable care to ensure that no person performs a controlled function under an arrangement entered into by A in relation to the carrying out by A of a regulated activity, unless that person is acting in accordance with the approval given by the appropriate regulator under this section. A controlled function in relation to the carrying on of a regulated activity by a PRA authorized person means a function of a description specified in the rules, or in relation to the carrying on of a regulated activity by any other authorized person means a function of a description specified. So in other words, this essentially says that a firm, you're an authorized person, you're a firm, you have a responsibility to ensure that no one who isn't suitable undertakes a regulated activity. Basically, this is compliance. Compliance says that the firm, as part of being authorized, has a responsibility to make sure that no one who is inappropriate conducts a regulated activity. So in other words, if one is a firm, one is regulated for the firm's conduct, but of course the firm's conduct actually is undertaken by individuals. And so you have a direct obligation on the firm to make sure that individuals are performing in accordance with appropriate approvals. Senior management. Now this is something that, in the context of the AI and finance article, is discussed quite a lot. And we'll come back when we're looking at some of the AI context of this. But this is a core aspect of the UK regulatory system, which is what is called senior management functions. And essentially, this says that you have firm responsibility. So the firm is responsible for complying with requirements. You have the individual responsibility. Individuals have to be fit and proper to undertake regulated activities. And this then says that in addition to the firm and the individual, certain individuals which are designated as senior management are responsible for those people's activities and the functions within that regulated activity. And suddenly, if you've got firm, individual, and management, you can see why, from the standpoint of compliance functions and compliance technology, large firms spend so much effort on this. We'll look at it from a number of different directions. A function is a senior management function in relation to the carrying out of a regulated activity by an authorized person if the function will require the person performing it to be responsible for managing one or more aspects of the authorized person's affairs so far as relating to the activity. You are director of trading. You are director of something. It's very clear that you have been labeled as responsible for a regulated activity that the firm has authorization for. And therefore, in addition to the firm and also the individuals, for purposes of that regulated activity that you're in charge of, you're responsible as well. Those aspects involve or might involve a risk of serious consequences for the authorized person, for business or other interests in the United Kingdom, and the reference to managing one or more aspects of an authorized person affairs includes a reference to taking decisions or participating in the taking of decisions about how one or more aspects of those affairs should be carried on. Vetting. This then gets us, remember we saw from the standpoint of the individuals that there needs to be reasonable care taken by the organization in the selection of these individuals. And so this is vetting. Before an authorized person, a firm, may make an application for a regulator's approval under 59, which is the senior management, the authorized person, the firm, must be satisfied that the person in respect of whom the application is made, the senior management application, is a fit and proper person to perform the function to which the application relates. What do they use? In deciding that question, the authorized person must have regard in particular to whether the candidate or any person who may perform a function on the candidate's behalf. So, we're selecting head of trading. Under the head of trading, you will have various traders. And so they are trading on behalf of the manager, the head of trading, who is responsible for this regulated activity on behalf of the firm as part of the authorization process. Has obtained a qualification, has undergone or is undergoing training, possesses a level of competence, or has the personal characteristics required by general rules made by the regulator in relation to persons performing functions of the kind to which the application relates. And this then takes us to some very detailed requirements in the context of FCA rules and guidance available in the context of the FCA website. Withdrawal. The FCA may withdraw an approval given by the FCA or PRA in relation to the performance of a person by a person of a function if the FCA considers that the person is not a fit and proper person to perform the function. So in other words, if one ceases to be fit and proper, that one can lose this authorization. Ceasing to be fit and proper can be the result of a variety of different circumstances, including criminal activities, insolvency, etc. Power to impose penalty. If the appropriate regulator, and this is PRA or FCA, depending on who's in charge in this particular function, is satisfied that a person has at any time performed a controlled function without approval, so our controlled function, these are our regulated activities, without approval, at the time the person knew or could reasonably be expected to have known that the person was performing a controlled function without approval, the FCA or the PRA may impose a penalty of such amount as it considers appropriate. So in other words, if you have someone who is either not authorized to perform the function, or they're performing the function in a way that is not appropriate, that is subject to a penalty. Rules of conduct. This is very important because the FCA, in addition to the statutory rules, produces a significant amount of non-statutory rules and guidance, which we'll take a look at in just a few minutes, which is around conduct. So if it appears to the FCA to be necessary or expedient for the purpose of advancing one or more of its operational objectives, the FCA may make rules about the conduct of the following persons. Persons in relation to whom either regulator has given its approval, so this is senior management, persons who are employees of authorized persons, so this is anyone who's an employee of an authorized firm, persons who are directors of authorized persons. So in other words, you have the conduct rules apply to directors, they apply to your senior management, but they also apply to all of your staff. And this means that, once again, from the standpoint of compliance, a firm is looking at how to make sure that, one, its staff knows the rules, and two, complies with rules. And so this essentially comes with what one would think of as training programs. And everyone knows that in an authorized financial institution, you're constantly going through online compliance programs. You're constantly doing different sorts of tests, updates on information as rules change, etc. But remember my trading floor example, this idea of on a trading floor that every word, every keystroke is monitored. This is supervision of activities by those personnel, etc., in order to essentially make sure that they are behaving in an appropriate manner. responsibilities. Rules of conduct, responsibilities of authorized persons. So in other words, we actually have a rule here which essentially says every authorized person must. So section applies where a regulator makes rules. These are conduct rules. Every authorized person must notify all relevant persons of the conduct rules that apply in relation to them. This sounds very reasonable until one actually starts looking at, one, what we've already been doing, which is the size of the core legislation, the FSMA itself. And also once one looks at essentially the online rule book and manuals that go with that, simply this idea of getting the information across to all staff about the rules which apply to them explains why in financial institutions you're constantly doing these online compliance programs and everybody hates them. But they will actually, some of these programs, you would actually have systems that will monitor eye contact to make sure that someone is actually looking at the screen while they're doing it. You'll have test results to make sure that you'll have certification that you've done it at the end. All sorts of mechanisms to try to get people to actually go through these processes. One, because you want them to do so, but two, also because the firm and the senior manager is responsible for the actions of those staff. Take all reasonable steps to ensure those persons understand how those rules rely in relation to them. And the steps which an authorized person must take to comply include, in particular, the provision of suitable training. Requirement for authorized persons to notify regulator of disciplinary action. This is an interesting one that may not be immediately obvious. In other words, if you are an authorized institution, you're a financial institution, you have a statutory obligation to notify the regulator about any disciplinary action which is undertaken against one of your employees. If an authorized person takes disciplinary action in relation to a relevant person is basically someone who is in one of these functions acting in relation to a regulated activity. So it has to be a disciplinary matter that relates to someone who is performing or involved in a regulated activity. It's not just anybody who's working for the firm. The reason, or one of the reasons for taking that action, is a reason specified in rules made by the appropriate regulator for the purposes of this section. Disciplinary action means any of the following: issuing of a formal written warning, suspension or dismissal, and reduction or recovery of any person's remuneration. And this is an interesting process because, of course, firms are constantly monitoring performance of their employees. This is finance, so people are constantly entering and exiting firms, often at very short notice. Firms have these continuing compliance programs, which they are also obviously trying to both monitor good performance. Firms are trying to find good performance in these monitoring and compliance processes, but they're also trying to identify problems. And this is interesting because this basically says that if a firm does uncover a problem in relation to a regulated activity and undertakes disciplinary action, that it actually needs to inform the regulator. Disciplinary powers. So, a regulator may take action against a person under this section, whether or not it is given its approval in relation to the person, if it appears the regulator is guilty of misconduct and the regulator is satisfied that it is appropriate under all circumstances to take action against him. For provision when a person is guilty of misconduct for purposes of a regulator, the regulator is entitled to impose a penalty, suspend for such a period as it considers appropriate any approval of the performance by him of any function, impose any conditions limit the period to which such approval is in effect, publish a statement of his misconduct, period for which may not exceed 2 years. Now, I want to pick up, this is a misconduct action. So this covers, for purposes of action by the FCA, a person is guilty of misconduct of any conditions A to C is met in relation to the person. Condition A, the person has at any time failed to comply with the rules made by the FCA, and at the time the person was an approved person, an employee of the authorized person, or a director of the authorized person. In other words, this is a power that allows the FCA to essentially cover directors, senior management, any employee of an authorized person for any form of misconduct which is defined as failing to comply with any of the rules made by the FCA. Condition B, the person has at any time been knowingly concerned in a contravention of a relevant requirement by an authorized person. In other words, that in addition to failing to comply, this is knowingly concerned, involved in some sort of contravention. So this in some ways is a sort of conspiracy or group sort of function. Condition C is that the person has at any time been a senior manager in relation to an authorized person. There has been at that time a contravention of a relevant requirement. The senior management was at that time responsible for the management of the authorized person's activities in relation to the contravention, and the senior manager did not take steps as a person in the senior manager's position could reasonably expected to take to avoid the contravention occurring. In other words, senior manager, if they don't take appropriate steps, is also potentially subject to misconduct enforcement if someone in their team has contravened the rules. So, one can see all sorts of different incentives for putting together compliance systems. What I want to do, and we've got actions for damages, for breach, removal of directors and senior executives, those are, and this is where I want to pick up. Little example, and then we'll take a short break. Odie's ex-CEO labeled him a sex pest, court told. Tribunal, and you do have rights of appeal to the Market Misconduct Tribunal. This is an appeal. So tribunal kicks off hearing of hedge fund founder's case against UK financial watchdog. Former chief executive of Crispin Odie's hedge fund told the financial watchdog its founder was, quote, a sex pest and, quote, a sociopath with, quote, a real problem in its attitude to women, a court heard on Tuesday. The allegation that Odie was someone who finds it hard to control himself around women came on the opening day of a court hearing, a legal challenge brought by the hedge fund founder against penalties imposed on him by the UK regulator. So think about our structure here. This guy, Crispin Odie, founds a hedge fund, but he hires a professional manager, a CEO, to manage the hedge fund. So that CEO as professional manager is clearly going to be responsible as a director, but also as a senior manager, for behavior taking place within the fund. So this case comes from a wide range of allegations against Odie about misbehavior, particularly to employees of the firm, which has resulted in his, so the case will determine whether the FCA has the right to ban Odie from working in the UK financial services sector and to fine him 1.8 million last year after he twice fired his executive committee to stop them holding a disciplinary committee meeting on sexual misconduct allegations. So in other words, as founder of the firm, he's hired a team of professionals to manage it. His misconduct becomes quite well known within the firm. They, as professionals, seek to perform essentially a disciplinary action against him. He fires them because he owns the firm, and therefore avoids the internal disciplinary action. But eventually, the reports are strong enough that you actually have a direct intervention by the FCA against him personally, which has resulted in both a fine but also disqualification for him from undertaking regulated activities going forward. And so this is an appeal to say that the FCA doesn't have the power to do this. And what you have here is testimony from the former chief executive of the firm about his behavior and their efforts to try to discipline him in that context. Now clearly, had they had to discipline him, they would have also had to report that disciplinary activity to the FCA. So in addition to not wanting to be disciplined by his own firm, he also wants to avoid it because that action would therefore draw an FCA investigation. So this, I think, provides a very nice example from the standpoint of essentially those powers of FCA intervention for misbehavior in the context of not being fit and proper. Clearly, this term fit and proper can extend to a range of things. This behavior isn't covered by fit and proper. There's a determination that therefore he's no longer fit and proper, and therefore that he shouldn't be subject, or he should be disqualified from the industry. All right, let's take a short break, pick up at 20 after 5, so about 7 minutes.
So I want to talk about three risks. So conflict of interest, discuss market abuse and insider trading. So the difference in,
Interesting. Yeah.
do you think it aligns with?
Yeah, that's good. Yeah. That's good.
Okay, that's all.
Yeah, that's good. Yeah. Yes. Well, that works very well.
But isn't market abuse slash insider trading partly conflict of interest?
It is, and so
overlapping?
that's s- some will argue that it is, but because there is, generally speaking, a specific legal regime, you can separate it out, and therefore say it's a different type of. It's a specific type, even if, and you don't have to say. You could say that you don't necessarily have to say that it's a conflict of interest. You can just simply say that there's a judgment that this behavior is inappropriate or against the proper functioning of markets, whatever. You don't necessarily have to define it as a conflict of interest.
And might it be interesting to talk in my introduction about that some say it's a conflict of interest?
Yeah, absolutely. Yeah,
And the last thing is information asymmetry.
yeah.
It is more a result of a conflict of interest, or would you say it's?
I mean, sometimes it's not necessarily. I mean, it's information asymmetry is a fact. It's not, and often that's what we do is we take advantage of things that we know that someone else doesn't know. That completely makes sense. But the question, as you say, is whether we're doing something that is really taking advantage or using something that is, we have the information in a form of trust or other responsibility so that it's not necessarily ours. And so, asymmetric information is just a fact, and it's not a bad, it's not avoidable. And in many cases, the fact that someone has gone and done the work to investigate something, and they have information that others, perfectly proper. So, and it's not even a conflict of interest. It's actually what you want them doing. So, the key then is whether what they're doing is in some way, um, taking advantage or unfair. Yeah.
That makes sense. And the last question is for my second risk, the market abuse.
Yeah.
I was thinking about market manipulation.
Yeah.
But I heard you saying in the beginning that not insider trading is the biggest problem, but fraud.
Yeah. Fraud. Probably in many ways, probably
Because
you're-
manipulation is fraud, basically.
it is, though it's often a specific form of fraud.
Yeah, since I just have 1,000 words for each risk.
Yeah,
I want to
so-
be really detailed.
Yeah, and so it may or may not be a form of fraud, but there's the view that manipulating markets is, it impacts the trust and confidence in markets in a negative way that is objectionable. It also is unfair to participants. So even if it's not necessarily fraudulent, the fact of manipulation is
But if
objectionable.
your intention is to manipulate,
Yeah, so
then it's
the,
fraud,
the,
right?
it-
Fraud
it-
is
it-
always with intention.
so the
in my
intent, yeah,
opinion.
exactly. So the intention is there, but one of the questions may be around who is it that you're actually defrauding? In other words, who is
I
on?
think
Yeah,
LIBOR is a really good example.
yeah. So this is a good example, and these are some of the things that make it sometimes fraud versus market manipulation. There's an argument that it isn't always the same.
Would you say there are events of manipulation where no intention is involved, that just happen? For me, manipulation seems really
Yeah,
negative.
I tend to think of it likewise. That manipulation means that someone is intending to do something.
to negatively impact someone else.
Yeah, or at least,
But I think there are different perspectives.
yeah. And so that's the intent, I think, is important in manipulation. Um, but then, yeah, whether there's someone who's actually identifiably defrauded is a different question.
And going back just out of curiosity, you said during COVID with the trading floor,
Yeah,
they
yeah, yeah.
worked from home. They use tools to
Yeah, yeah,
monitor the employees.
yeah, yeah, absolutely.
Isn't that infringement of privacy?
It may be,
it's
but
in someone's house,
Yeah.
maybe family members are
yeah, and this
or the
is
internet server.
yeah, this is and so
There was
the
not a lot of
the
discussion about
yeah, and it was one of those things that pretty much you know that it is a sort of privacy violation, but it's also one of those things where it's an explicit obligation to track. And so, from the standpoint of a financial services employee, it's explicitly, giving up one for the other.
So there was no
Not
case.
Not really. That
I think-
mainly because people, they would have tried to avoid, and the firms would have tried to avoid as well.
Yeah, it's your job, so you probably don't mind. But
Yeah.
maybe there was some leak or
Exactly. And
employee
so
was,
it's
didn't want it.
where this has been much harder is in the context of monitoring communication channels like WhatsApp. And this is
Then
where
your private conversations get involved.
exactly, and that's something where firms try to say that people can't use it, but it doesn't work.
Yeah.
And there's no way to monitor it. And so, yeah, this is one of those areas where with a trading desk, it's one thing. But like WhatsApp and a phone is entirely, and that's often why firms will actually you'll have an office, a firm phone.
Yeah.
And you know that everything that happens on the firm phone
tracked,
is
monitored.
recorded. And then you'll always have your own phone as well, because you're not going to put your personal stuff, or you shouldn't put your personal stuff. But like with
maybe the
WhatsApp,
opposite.
it becomes
Okay,
unavoidable.
but maybe the opposite. You don't say don't put personal stuff in work phones. Since
Yeah.
it's being monitored. But why not the opposite?
Exactly,
Texting with
exactly,
colleagues over private.
exactly. And this was libel as well as you had the private communications. So yeah, that's
It's
one.
a hot topic.
Yes, it is.
Interesting.
Yeah. Hey, sorry. Yeah. I have one, but I was thinking it was tomorrow rather than Friday. I'll double check. I'll send around a message. Because
They're all like some sort of like
yeah,
house
I'll double check.
keeping the old stuff, setting up new windows,
I think it's been shit.
we're opening more windows because
Let me double check. Yeah, let me double check.
and my sister is
Yeah.
it's causing a lot of fights.
We'll provide the topics, but since we haven't taught this course before together, we don't really have essays. And the previous teacher taught it before, so we don't really have essay examples, but we will go through strategies and approaches and content. I'll double check on this Friday. Yeah. You're welcome. All right, everybody, let's pick up. What I want to do for this last segment is change directions a little bit. We'll come back so if we look at, we'll come back in a couple of weeks' time to some of these issues again around market abuse and investor protection. Next week, we're going to be turning to information intermediaries, particularly credit rating agencies, before turning to crypto and special purpose acquisition companies, or SPACs, at the end of the course. Daniele and I will send around a note later today We have a guest lecture coming up in sustainable finance topics, and we'll confirm the time and date on that. So, what I actually want to turn is this term that I mentioned at the beginning, and next time we'll look at this from a sort of evolutionary perspective. But I want to dig in on a couple of pieces to wrap up today's session. RegTech and SupTech. Use of technology, particularly IT, for regulatory implementation, compliance, and monitoring by regulators, supervisors, market participants, infrastructure providers, and others. In other words, if we think about RegTech and SupTech, as I said at the beginning, people will often say that SupTech is the use of technology for supervisory purposes by supervisors. That general consensus on. And people will often say that RegTech is use of technology by market participants for compliance purposes. And that suggests that the two are separate things. But in reality, they are almost always interrelated. In other words, who sets the requirements that the industry has to comply with? The regulator. The regulator sets the regulatory requirements that RegTech is used to comply with. The regulator uses supervisory technology to monitor compliance of the industry with those requirements. Very frequently, one aspect of regulatory compliance is the industry participant has to submit information to the regulator in a digital form, RegTech. But the supervisor will then use technology to analyze that information for supervisory purposes. In other words, very frequently, RegTech and SupTech are two sides of the same coin. In other words, the regulator sets the requirements, the industry builds technology to comply with those requirements, and the supervisor uses technology to supervise and monitor compliance with those requirements. And as we saw with the NASDAQ example, the reality is that the major providers of RegTech and SupTech services tend to be major industry players like NASDAQ, LSE, Amazon, IBM, and a number of others. And very frequently, these firms will sell to both supervisors and industry. In other words, NASDAQ starts as an exchange. It builds technological systems to analyze behavior on its own exchange. So in other words, if we think about NASDAQ established in 1974, world's first fully electronic stock exchange. That means that from the beginning, it has fully electronic trading records of all transactions across its exchange. Now, NASDAQ, not surprisingly, uses that information to try to monitor for misconduct, manipulation, fraud, etc., in the context of trading on its own exchange. So over time, it develops data analytics systems which it uses to monitor behavior of traders on the NASDAQ exchange. that data, under supervisory powers, is also fed to the SEC as market regulator. So the market regulator, the SEC, is also getting the data, the analytics from NASDAQ, monitoring behavior on its exchange. And NASDAQ, being a commercial company, determines that why don't we also sell this software to investment banks and traders who are having to monitor the behavior of their own staff. In other words, Goldman Sachs needs to monitor the behavior of their staff in the context of their trading activities, and their, if you will, the regulator, the SEC, is using this technology via NASDAQ to monitor. Why not sell the same technology to Goldman? And actually, you can sell the technology to Goldman for a lot more than you can sell it to the SEC. In the SEC's case, you have to give them the data anyway. But if you want to go to other stock exchanges around the world and sell it to them, or you want to sell it to other securities regulators, their budgets are going to be smaller than Goldman Sachs' budget. And this is something that, from the standpoint of RegTech and SupTech tools, if you think about it, what you really want to be able to do is you want to work with the supervisor to build a monitoring tool which they use to monitor behavior in the industry. And then you want to be able to tell industry, we worked with the supervisor to build the tool that they use to monitor behavior. And we would like to sell you that tool. Now, there is clearly a potential conflict of interest here. But the argument is that what they're doing is in support of regulatory objectives and enhancing compliance. In other words, they are getting paid to help the regulator develop a better monitoring system, but then they're getting paid to help industry implement that system in their own operations to better monitor their own compliance. And that's essentially this idea of RegTech and SupTech going together. Sometimes people will argue that these just apply to financial services. And the reality is that RegTech and SupTech now apply in any regulated industry. In other words, if we think about healthcare, you have regulations, people use technology to comply with those regulations, that's RegTech. Supervisors use technology to monitor compliance with those regulatory frameworks. That's SupTech. We have this in transport, we have it in energy, we have it in data standards. Any regulated industry today, you will have industry using technology, RegTech, to comply with those regulatory requirements. And in an increasing range of industries, you also have the supervisor using technology to monitor compliance with those regulatory requirements. So, RegTech is one of those things that maybe it started in financial services, though there's even an argument about that. In other words, if we think about this aspect, and I can really pick it up from, say, this NASDAQ example in the early 1970s, one can also think about something like nuclear energy. From a very early standpoint, you've had remote monitoring systems for nuclear power plants from the nuclear regulators. Why? Because the negative externalities of a problem with a nuclear plant are very significant. And so typically, the monitoring of certain data aspects around nuclear power plants will be monitored at a distance by the supervisor. That's SupTech. It is monitoring, it is using technology to supervise an industry. So, RegTech, SupTech, not something that is only finance, but finance has undoubtedly been the biggest user. Increasingly, and I'm going to come to this example in just a few minutes, RegTech and SoupTech come together via specific forms of infrastructure. In other words, increasingly it's the case that a regulator will say, you have to report certain information. That information has to be reported in a digital form, and that information has to be reported in a certain reporting system. That reporting system is an infrastructure. It's a system that all reports are made in. The reporting into that system enables the supervisor to monitor the data and information that goes into that system. And the process of creating the information and packaging it in the required format and submitting it into the system, that's RegTech. So increasingly, we're seeing the interaction. Probably the area where we see this most clearly is in the securities and capital markets context. A bit of context, and I use these numbers largely because they're the best numbers I have pre-ChatGPT. Why? Because the advent of generative AI changes a number of these directions. We're not really sure where some of this is going at this stage, but we'll come back to that with some survey data a little bit later. Drivers. One, this idea of fines. Between 2008 and 2021, industry, financial services globally, was subjected to over $380 billion equivalent in fines. We had a really dramatic increase in enforcement post-2008. And as a result, really quite dramatic increases in the amounts of fines paid by financial institutions around the world. Clearly, those fines are not inconsequential. We'll see in some cases examples, particularly in the money laundering context, where fines may be billions of dollars. So the fines can be consequential themselves. But it's also the case that getting fined by a regulator, this has reputational consequences. In other words, if we look at Crispin Odey, the hedge fund, they've basically had to close down because of the behavior of their founder, but also because of the regulatory action against their founder. In other words, the regulatory actions will have reputational and business consequences for firms beyond just the cost of the fine. And as a result, firms try to reduce the amounts of fines that they get, but also the amount of regulatory actions. And as a result, we've had lots of firms increasing compliance spending to be able to catch issues themselves instead of the regulator catching the issue. Much better to be a firm and say, we have discovered this issue, than to have someone come in and say, you missed this, how did you miss this, and then to fine you as well. The financial sector, including in the context of AI, has for a long period of time been one of the biggest spenders on technology. 2021, estimates suggest that financial sector's tech spending globally was somewhere over $600 billion. So the amount of money that financial institutions spend on technology is significant. These two pieces of data are relatively easy to get. The fines, it takes some amalgamation, but that's fairly solid. Most of those are public. And from the standpoint of tech spending, this is something that, once again, is generally available in the context of annual reports. So this is a pretty robust number. Oddly, despite the amount of complaints from the financial sector about compliance costs, the amount that financial firms actually spend on compliance isn't very clear. It's not really itemized. It's not like in your annual report you say you spent this much on compliance. It's a variety of other costs that often aren't necessarily clear. The end result is the estimates are that in 2021, the global financial services industry spent somewhere between 300 and 700 billion on compliance, which is a lot, but not an entirely certain figure, and that approximately 40 to 50% of that, back to the earlier point about technology, was spent on technology. Today, this decade, firms spend as much or more on RegTech, compliance technology, as they spend on the compliance personnel. And this is something that, if anything, may be accelerating. If we look across our financial regulatory objectives, we're really seeing RegTech and SupTech used across the full range. We'll get an example in the sustainable finance context a little bit later. And if we look at,
I have a question regarding embedded supervision. Is this something that's only a concept only used in decentralized finance, crypto, or can we see that in the financial sector?
yeah, so this term, embedded supervision, or the related term, embedded regulation, it has to be said that with co-authors, Raphael Auer and John Frost, we were some of the first people to actually investigate these ideas. Embedded supervision basically is the idea that you can have supervisory processes embedded into systems. You can automatize supervisory processes. We were initially looking at it in the context of, say, decentralized finance. But if one is thinking about a system whereby you have like an exchange, data are being, for instance, automatically reported to an exchange about trading activities. Those data can be automatically analyzed, and the end result is essentially the regulation and supervision go together from the standpoint of an automated protocol. If you want to look at an example, a friend of mine at Cambridge, it's called RegGenome. And essentially their idea is that you could actually automate both compliance and supervision. In other words, that for a financial firm, that data could be collected automatically and submitted to the regulator. Those data could be automatically sort of analyzed by the regulator to even result in enforcement actions, but ideally what you would get is much improved compliance. So it's not just in decentralized finance, you could have it in other sorts of contexts too. We'll look more at that when we look at crypto later on. Yeah. So if we look at who are the sellers, you have startups, and in the same way that we talk about fintechs, you have regtech firms, but what we are seeing is that this is an area which seems to benefit from scale. So startups are being pretty quickly acquired by larger firms, and those larger firms tend to be things like incumbents, like NASDAQ, LSE, but we're also seeing real growth from the standpoint of the big techs. Amazon has an entire financial services department that effectively sells RegTech, SupTech solutions based on shared cloud infrastructure. Supervisors, infrastructure providers, individuals, very heavy participation not only from the techs and the incumbents, but also from the standpoint of consulting firms. Your big four accounting and auditing firms have basically come to the conclusion that if, in addition to selling advice on compliance systems, they can also sell the tech, that this is a very good growth area. Where are we seeing most use? Most use is what I would flag as efficiency or conduct. These are things like digital regulatory reporting. So we talk about things like reporting obligations under MiFID or the US securities obligations. All of these things result are digital regulatory reporting initiatives. And this is probably the area where we're seeing the greatest use of both RegTech and SupTech, and also, as it happens, the use of AI for supervisory purposes. We're seeing a fair amount from the standpoint of prudential supervision and regulation, largely as a result of dramatic increases in the amount of information that firms have to report. I'll come to an example later. AML is obviously a big area, sustainable development and inclusion, and increasingly things like data and cyber security. Origins of this really come in some ways from a project coming out of that NASDAQ experience in the 1980s. And essentially what this is, EDGAR. EDGAR is a SupTech infrastructure. Essentially what it is it's a system that every US securities disclosure must be put into. In other words, if you are a securities issuer, you're a securities trader, any information regarding those activities will go into the EDGAR system. EDGAR, Electronic Data Gathering, Analysis, and Retrieval System, is the primary system for companies and others submitting documents under the Securities Act of 1933, Securities Act of 1934, Trust Indenture Act of 1939, and the Investment Company Act of 1940, containing millions of company and individual filings. EDGAR benefits investors, corporations, and the U.S. economy overall by increasing the efficiency, transparency, and fairness of the securities markets. System processes about 4,700 filings per day, serves up 3,000 terabytes of data to the public annually, and accommodates 40,000 new system filers per year on average. So, this is a database of basically all filings in the US. It's available to the SEC, but it's also available to the public. In other words, you can access this data. One of the reasons from the standpoint of finance academia why US markets are so often more analyzed than other markets, the data are really easily available. It's there, it's all standardized, you can easily take it, analyze it, do whatever you want with it, and this arguably has actually had quite an important role in supporting US market functioning. Those ideas of efficiency and disclosure to make markets function better. So, this is something that we've actually seen an increasing range of countries build similar sorts of systems. And where I'm actually going to wrap up is actually to look at an example of one of these, which I think also provides a nice interaction, not only from RegTech, SupTech infrastructure, conduct monitoring, but also the role of AI in these systems. And this is the website of the French capital markets regulator, the AMF. And this press release, this page, is from October of 2020. So October of 2020, this is 6 years old almost, but it's also pre-generative AI, pre-ChatGPT. So this is AI and big data at the AMF in 2020. Big data and artificial intelligence have been standard practice at the AMF for a number of years now, enabling the regulator to handle the large volumes of data needed to perform its missions and analyze those data in record time. From market supervision to the detection of scams, AI and big data provide capabilities to address multiple use cases. Why? So this is, if we look at it, the AMF needs to be at the forefront of technology in order to carry out its mission to protect investors, monitor the smooth operation of markets, and provide information to investors. Sounds rather familiar, those regulatory objectives. Over the years, the market regulator has made significant investments to ensure that it has the best expertise, so that's human capital, and highest performance technical resources, such as its market supervision platform, ICY. So ICY is thus one of these SupTech infrastructures. The IC platform, based on big data technologies, was in-house developed in 2016 and rolled out mid-2017. Enables the AMF to quickly and efficiently process large volumes of structured and unstructured data. Structured data, think about all of those IPOs and periodic reports of financial institutions and issuers. That's structured data. They have to be in a certain format. It's all comparable. And unstructured data. Unstructured data are often things like news reports. It's not in the same way structured and comparable as one might think about annual reports by a listed company. The regulations adopted in the aftermath of the 2008 financial crisis have enabled regulators to broaden the scope of data available to them. One has to love this phraseology. Regulations adopted in the aftermath of the 2008 financial crisis have enabled regulators to broaden the scope of data available to them. What does that mean? It means the post-crisis regulations dramatically increased reporting requirements for industry. So, yes, regulators are accessing more information because they're requiring the industry to report that information. But that means that regulators have vast amounts of information that they didn't have earlier. And that means you need systems to be able to do something with it. In 2019, so this is the year before this press release, the platform absorbed 24 billion data lines. This year being 2020, it could integrate more than 100 billion data lines. And that's gone up by a multiple over the past several years. From machine learning to deep learning, AMF released the first AI applications on ICY in 2019. Today, machine learning or automatic learning works for several AMF market abuse or market anomalies alerts. In other words, the system is designed to try to detect market abuse or other sorts of anomalies that may be a concern. Using algorithms that link data independently or predictively, the AMF is able to identify anomalies that would have gone undetected by traditional algorithms. In other words, the big data analysis combined with machine learning allows the AMF to detect patterns that it may not have otherwise seen. Now, there's a huge aspect of this. If you're the industry, what you want are essentially real concerns. In other words, you don't want the regulator calling you every 5 minutes and say, we've just discovered this, we need you to analyze and report back. What you want is for the regulator only to call when they've discovered something real, because it's going to take you putting some effort in to get the information that they want. Now, you would prefer them not calling at all, so you prefer your systems to work better than their systems, so that you can actually identify issues before they do, so that the call doesn't come in the first place. But if the call does come, what you don't want are what we call false positives. They call up for something that's a false alarm that you then have to spend resources on. Industry hates that. It has succeeded in reducing the number of false positives, a market configuration that the system would have previously identified as a possible market anomaly, thus triggering an alert, which after analysis turned out not to be an anomaly. The number of alerts generated by the system has thus been halved with the use of machine learning. In other words, pre-Gen AI, they're already using machine learning from the standpoint of analyzing market patterns and using it to reduce the number of alerts but increase the accuracy of the alerts that come through. The AMF is also working on deep learning applications. Thanks to natural language processing, the AMF can now make unstructured data, such as text, suitable for processing by traditional algorithms. Now, this is the area where generative AI is having the biggest impact, is around natural language processing and processing of large volumes of unstructured as well as structured data. Artificial intelligence is used to reprocess a text to make it automatically meaningful. The AMF is also investigating the possibility of detecting suspicious market configurations through image recognition. Image recognition basically says that fraud, market manipulation, there are certain patterns. And those patterns, you can just look for the pattern. In other words, you can just look at trading data, and if you see a pattern that is typical, maybe there's no reason why you would look otherwise, but the pattern matches. And so the system says, here's a pattern, it matches. Someone in the agency will then be triggered to investigate. Is there something to that pattern that actually is of a concern, or is it completely random, or is it just a false alarm? And so we're seeing increasing uses of this idea of pattern recognition from the standpoint of trying to, one, recognize patterns of behavior, particularly objectionable behavior, and then try to identify those patterns when they come. Multiple possibilities from market supervision to the prevention of scams. The AMF is using the same tooled approach to data exploration and analysis to develop other fields of application as detection and prevention of scams. Thanks to AI, the AMF can significantly increase its ability to identify fraudulent websites in order to feed its blacklist, like the one we looked at from IOSCO earlier, and issue alerts to the public if and when necessary. And this is one area where machine learning and where we may see a significant amount of application in agentic AI. In other words, we started out, and every day, just like those announcements on the IOSCO website from the FCA we looked at, every day there will be alerts that will come around the financial services industry about fake websites. Very